Welcome to the Gray Report. Breaking news in the multifamily and commercial real estate industry. Green Street has just put out a report calling the market has bottomed. You heard that right. Commercial real estate prices, according to Green Street, have bottomed, and especially multifamily, seeing incredibly strong demand. We're going to get into that piece, but also an article from RealPage, again, cementing multifamily's solid footing in the industry today, even though there are an incredible amount of challenges still facing the industry, such as slow rent growth, loan maturities, all of that. But we're seeing, according to RealPage, again, U.S. apartment demand surges in the second quarter, almost hitting record absorption levels. This is exactly the news that apartment investors have been looking and hoping for. Maybe not as good as lower interest rates for some, but if you are someone that's been focused on the fundamentals and the long-term prospects of multifamily, this is welcome news, and it's confirming some of the instincts that many of us have seen and had in the industry. Might touch on the latest Yardi Matrix report for June 2024, but then also shifting to affordability, Globe Street, rent control's impact on multifamily, and then continuing to dig in from the Harvard Joint Center for Housing Studies' latest annual report. Again, another blockbuster, very long report. We're going to get into the topic of the middle income housing credit, the concept of that, instead of just, issuing rent control, it's really kind of stems new development and decreases investments. Are there policies similar to LIHTC or the low income housing tax credit that could work, that essentially, subsidize the development of low, and in this case, maybe moderate or middle income housing? Is that a solution? Is that just more government intervention? We're going to talk about all of that and more. So let's get into it. Welcome back to the Gray Report. I am joined once again by producer and director of communications and marketing at Gray Capital, Dr. Matt Bosnagel. Matt, how are we doing this week?
I think I'm doing pretty great. Some new stuff's happened, so it's not all the same. So it's really nice.
No, we do this every week, Matt. We've been doing it every week now for almost 4 years, and it can seem the same, but that's just because we've got our pulse on it and we're checking it every week. But this week, as you said, things have changed. I mean, this piece, when I first saw it come across the wire, it made a big impact because that's the question that many investors have been asking is, where are we in the cycle? We've talked about the clock of the market cycle. What time is it for multifamily, with 12 o'clock noon being the top of the market? So that was second quarter 2021, when prices absolutely peaked. But where are we? Are we at the bottom of the market? We know prices have declined 20 to 30%, but are we absolutely at 6 o'clock? The consensus is we're probably somewhere between 4:30 and 7:30, or somewhere kind of near the bottom, but not sure have we gone past it or not. This Green Street report, Matt, essentially is saying we've hit that bottom. So we're just past 6 o'clock, which again is incredible news because, and again, I don't think we're out of the woods. I don't think we should, start counting all our chickens just yet. It's more of a very positive sign, and it's a data point. So we have to keep looking at the data points because, again, a lot of folks were concerned. Investors, we've been waiting again for this sign of where we're at. Again, a sense of we're at the bottom. But essentially, again, this Green Street article on their commercial property price index puts us basically that, we have bottomed out and we're starting to see increases with the Green Street Commercial Property Price Index increasing 0.7% in June. Matt, what are some of your takeaways from this report?
Yeah, I think that the big takeaway here is, sure, okay, 0.7% increase. That's okay. It's not great, and the index right now, like if you're talking about like absolute value, is quite low. It is at the same time. It's at the same place that it was. So on the way kind of up from the pandemic lockdown. So the last time it was this low was in December of 2020. I'm sorry, November of 2020 in the months over those after the pandemic lockdowns. And then before that, actually, the last time the index was at this point was in October of 2015. My point is that property values as measured by this index have a lot of catching up to do. So it's a little bit natural in terms of like the technicals that it would bounce back from this relative low point. But digging into the reasons, the specific reasons beyond a magic technical line moving, is apartments. Apartments are moving all of this. I don't get out of bed for a 0.7% increase, but what about a 4.9% increase? What about 7 times that increase? That's how much apartments have grown in just the past month. Again, we are still making up for a lot of decreases that have happened since like December 2021 or shortly thereafter.
Off 22% from the peak.
Yeah, we're off the peak, but we are going. We're getting positive, and the amount of gains in the apartment market specifically is lifting the entirety of the other of all other property types. I think that's incredibly notable, and it's worth mentioning that industrial, mall, office, strip retail, data center, healthcare, all of those didn't change at all last month. The only thing that changed was apartments, and they went up 4.9%. So that's very much worth noticing. And I would argue that in terms of maybe apartments specifically, but CRE in general in this index, that 0.7% is the second month of growth in the property price index. So if we are bottoming, or if we have bottomed, maybe we bottomed 2-3 months ago, and we are starting to now tick up. So it increased last month and increased this month. We are 1 month away from a bona fide trend, is what I'm saying. And it's also, okay, we got those 2 months of increases. It could tick down, but those last 2 months are the first time that we've seen actual increases since December of 2021. So that's like, it's also very notable that they're increasing period, because it hasn't even budged in a positive direction for like over 2 years.
Yeah,
a lot of things to celebrate, I think.
I think what's notable, Matt, is, and again, I think it's worth reminding everybody, because this may seem like, okay, well, yeah, apartments are always good, but we have to go back. Acknowledge we're not out of the woods. There's still a lot of loan maturities that are coming up. There's still a lot of distressed properties. We're still going to see foreclosures, but we have to remind ourselves that multifamily, while the fundamentals have always made a lot of sense, kind of take the capital markets interest rates out of it. We're dealing with a ton of supply right now. We're going to talk about absorption here in a second. But multifamily, what was different from other sectors, hospitality, retail, industrial, office especially, is that multifamily increased in value so much. Like office properties didn't really increase in value much in the pandemic. They were flat and they declined. Hospitality properties, they were volatile. Industrial saw some nice gains for sure. But multifamily saw some of the most gains, and so the higher you climb, the more room you have to fall. The thing that we're seeing similar declines saw similar declines relative to other sectors, kind of low 20% range, but we're bouncing back that much quicker. I think it really highlights the inertia that's driving the fundamentals for multifamily right now. And this is going to be a key signal. And again, remember, this is on the backs of Blackstone and KKR making huge bets in the multifamily sector. So, this is on the same data that they're seeing and leading them to make multi-billion-dollar decisions. Now, we still have a lot of more retail and middle market investors out there, still very fearful. For understandable reasons, like we mentioned, the loan maturities, all the supply, slow rent growth, interest rates, et cetera, et cetera, et cetera.
Yeah.
The question is, do you buy now for basis while prices are low, while there's some short-term headwinds to take advantage of the long-term trends, the long-term fundamentals that are highlighted by this record demand that we're going to talk about in the Real Page article? So again, people have to ask themselves the question, is it worth waiting until we're absolutely in the all clear? As I've heard some investors discuss, I had a conversation with a big family office, Matt, over the holiday weekend. And, I asked them what their thoughts were on investing in just real estate in general right now. And their thought was, they're like, we want to wait for the all clear. We want to wait. And this is an interesting metric. It's understandable there. They said, we want to wait until we see the 10-year treasury drop below 4%. Once the 10 years drops below 4%, then we can get some real natural positive leverage without having to buy down rates or do anything crazy. And there should be a nice cap rate and interest rate spread there. The problem with that, it's sound thinking, it's conservative thinking, is that you're probably going to, chop off some of your potential for highest returns, because again, to get the basis to buy low, by the time that interest rates are low, we're already seeing strong buying activity. We're going to see sellers come to market, finally bring properties out, and the floodgates will be unleashed, Matt, because every asset manager, every apartment investor is going to be piling in. Again, because we're on this macro conversation of, apartment and commercial real estate investing and alternative investing through family offices, registered investment advisors, which I think is going to be a massive trend over this next decade. The last cycle saw these wealth managers, RIAs, starting to dip their toes into kind of private placements, and multifamily is one of those darlings. And a lot of them weren't able to take advantage of the last cycle. Maybe they did a deal, but they were trying to ramp up their platforms, how to get their clients allocated. And we're talking about billions of, I don't know that exact number, Matt, I should, but it's hundreds of billions, if not trillions of dollars of ultra high net worth individuals. Capital that is managed by registered investment advisors, these wealth managers. And they're all saying, hey, look, I need to have exposure to alternatives. I need access to multifamily. These groups have been just figuring out the right way to get their clients into these deals. Not to mention every single office investor, they're not going to invest in office right now. They're going to be looking at what works, and that's multifamily, that's industrial, and then some of the other niche sectors such as hospitality, retail, and opportunistic office. So I think we're setting ourselves for a really nice cycle. Again, knock on wood, nothing set in stone. We could see a black swan event. We still have loan maturities that are coming. I mean, we still have folks people will lose money and have to hand back the keys to lenders. High profile building in Indianapolis, Matt, that we discussed several weeks ago on the Gray Report, now is being sued, going into foreclosure. That's not the last time we've seen that. We're going to keep seeing it again. But if you are not bogged down with distress, it's a great time, I think, to get into the market.
Yeah. That was another article that I didn't have time to include in the Gray Report. Was this is recent Wall Street Journal article about how banks are looking at fraud now that property values have gone so low. It's revealing some mortgage fraud potentially, and it's becoming a problem.
Nice surprise. Yeah. Just like the last cycle. I mean, there's so much fraud that's going on in every industry, not just real estate. Certainly real estate is no fraud is not new to the industry, but yeah, it's unfortunate.
It is, and just in terms of timing, it is so interesting. What we're talking about now, and versus what we were talking about a whole year ago when we were talking about loan maturities and how so much we were focusing last year on the fraught position, and little did we know that the extend and pretend would extend it till now. And those exact feelings that we were mentioning, they're really coming to fruition now. We may have been I don't know, maybe 6 months off or so on the pain that people have felt, but the magnitude of pain is still going to be there, and it is like we did kind of say, it's spread out until now, and there may be no way out for some people.
Yeah, man, I think if you go back to our report, I think we were pretty clear on this whole year was we were going to see high pressure. There's just going to be a generally high pressure environment for many of those borrowers who took out floating rate bridge loans, who had purchased at the top of the market, and their interest rate essentially went from 4% all the way up to 8 to 9%. And that loan's coming due, and the lender says, I don't want to realize that loss either. Maybe if interest rates come down, let's just kick this can down the road. But as we talked about, banks are Not as patient as they used to be.
And it's interesting, we saw that danger now, and I think that a lot of other investors too see opportunity now when they're writing about the troubles in the Wall Street Journal, but people who are on the ground are like, no, this is a good time to start. Actually, some people that are making headlines may be in distress and stuff, but we're seeing a buying opportunity, and I don't think sure there are people that are going to wait for rates, but I think that a lot of syndicators, buyers, etc. They see an opportunity. They're not fools, and they know what's going to happen to interest rates and to the apartment market largely, and that's what's driving this whole 4.9% increase in a single month on the Green Street Price Index.
Yeah, Matt, I'm trying to locate a chart that I saw that Blackstone had published, or BlackRock had published. Sorry, not Blackstone. Are essentially talking about this idea of timing the market bottom, and they went back to the last cycle, and I'm having a hard time finding it, but it'll be around here. I can describe it. Essentially,
I'll fill it in right here.
They tracked the actual market in price movements with articles that were coming out. And the majority of articles that we're talking about, a crash in the real estate is, heading down, and just negative articles about apartments, but really real estate in general, all were written and published after the market had actually bottomed. And there was little information about there was going to be a crash prior to. So if you're reading articles,
very interesting
in that it's percolated up to the Wall Street journals and those folks, and they kind of get word of like there's something going on here.
Yeah,
the bad story has already passed, and we're just reporting on what has already occurred, and often we're actually now on the upswing. So I think we see some of those articles still popping up, being like there's a lot of negativity out there. Again, none out of the woods. There's definitely challenges, but when I see Blackstone and KKR, Great Capital, we're also making moves. I see some really smart folks can follow the smart money. Not always the right thing to do, but it's not a bad strategy. I trust their decision-making process, actually putting dollars to work, as opposed to a journalist who is casually interested in real estate and casually follows the multifamily market to make a significant call, which for an article that is more or less written for the layperson that's not in the real estate industry. So I think it's a great time to get in. Let's go over to this RealPage article, Matt.
Totally.
Let's talk about. We're talking about good stuff. If you're a listener or viewer of the Gray Report, which if you're not what you are, you're listening or you're watching, make sure you subscribe, leave a comment. We don't shy away from the negative stories. We'll be like raising a lot of money for a real estate deal, and then we'll talk about articles that are like very negative for whatever reason. We're going to be throwing a lot of positivity today, just because that's what is actually what we're seeing. But not every episode is like this. We don't usually pull really any punches when it comes to the good, bad, or the ugly. Okay, RealPage, U.S. power demand surges in the second quarter. Matt, this is some really surprising metrics. Essentially, there have only been a handful of other times in the last 2 decades where we've seen absorption levels this high. I think only 4 times. Two of those were in the pandemic. Makes sense. One was in 2018, and then you have to go all the way back to 2000 to see demand mirroring what we're seeing today. And this is in the face of record new supply coming online. So it's exactly what we needed. And again, so second quarter 2024, I want to read this. In fact, it's the impressive demand reading in year-end second quarter 24 may be difficult to overstate. And this is a huge deal. And so as excited we are, we can't be overstating this. Some 390,000 apartment units were absorbed just in the half of the year. That is the same amount of absorption we would often see in a single year pre-pandemic. That's absolutely insane. That means we're on track to absorbing over 500,000 units this year, which is, again, very impressive in terms of demand. It's you're able to take a little bit of a deep breath, because we knew that there was almost 800 to 900,000 units under construction. Maybe we're going to be delivering anywhere from 600 to 800. It all depends on kind of when things actually get delivered or not. We needed this absorption to keep the market kind of steady moving forward. This is also being reflected in rent growth, which is essentially kind of flat right now. We're not seeing as much negative rent growth. We can talk about the Yard report that gets into more detail on that, Matt. But again, in the face of, and this is why I think it's safe to say maybe prices have bottomed and now's the time to get in.
Mm-hmm.
In spite of record supply. We've never built this many apartments ever in the history of apartments.
There's a Jay
Parsons. United States of America.
Yeah. There's a Jay Parsons. They're talking about generational. It really is a generational supply wave. We're not going to see this, for 20, maybe ever. I don't know. I don't know how population trends are going to go, but seriously, this is a lot. More apartments were built in the first half of this year than were built in any single year from 2000 to 2015. That was from a Jay Parsons LinkedIn post that I saw yesterday. So yes, there is demand that's coming up to meet it, but it is not quite exceeding supply, and the supply is still a whole lot. Like, that's the historic thing. The demand, we saw demand roughly the same in 2018, so it's not completely unprecedented, but it is recovering quickly.
But look at the search. I mean, you're right. We're delivering more units, but again, this could be so much worse, and the demand is really coming to meet supply. Yeah, that gap is still there, but again, if you look at this chart that we're showing right now, we really bottomed out near the end of 22, early 2023, which again, sometimes you have to look backwards in time and what was going on with your own portfolio and how you were feeling. It definitely seemed like the dark days where things were absolutely slowest. I mean, again, maybe it's anecdotal, but now I'm seeing the data. It's like, that's when we were having some of the most operational struggles, because we were also facing rising inflation at the same time. So our prices were going up, but our rents were flat, or we had a lower rents, or our occupancy was going down. So now to see this surge back, and the slope has evened off a little bit, but still, when all the supply starts, it's not going to turn off, as we've talked about. But once it recedes back to more historic levels, I think we've got a nice cycle in front of us.
Yeah, and that's what I was going to note. The gap is definitely shrinking, and it may be shrinking a little bit less sharply than it was before, but it is definitely coming off, and it's not going to be forever that we're going to have this imbalance between supply and demand. We know the finitude of this supply wave, and it's on its way down, for sure.
Yeah. And then just looking a little bit, some market snapshots, man, we can just go through this real quick, and maybe we don't even need to talk about the Yardi article unless we want to get into it. We can save it for next week. We talk about the Yardi piece, the articles all the time.
I'll note a couple things about the Yardi, but through this Real Page thing, this is a clear illustration of how much apartment building there's been in the South. The South is the only region with an average of negative rent growth at negative 1.4%. The West is flat with 0%. The Midwest has 2.6% rent growth. Northeast 2.4%. And then again, to show how much the overbuilding in the South is weighting the overall average for rent growth, the overall is 0.2% year-over-year rent growth. So that negative 1.4 is pulling the other side all the way down into the negative because of the sheer amount of apartments that were built there. I think
it's also worth noting, Matt. I just want to say it's also worth noting that while the South is seeing some of the largest rent declines, they also saw some of the highest demand. I mean, absorption levels of any region in the country.
Yeah. And also, just to add a little bit about the Yardi report, which we can get in, and I'll include it in the show notes and include it in the newsletter. If you are subscribed to www.graycapitalllc.com/newsletter, you can go and subscribe there to our free weekly newsletter. However, the Yardi Matrix report did note in a special section on increased expenses and low rent. That story that you mentioned that was depressing us in 2023, that's still a story now. The rent growth is still fairly low. It looks promising, but the snapshot right now is it doesn't look great, especially when you're talking about expenses. And we were even talking about the long tail of expenses in 2023, in the early 2023, and how the way things are calculated, an expense that was high in 2022, it may go on the books and then actually be incurred by apartment operators in 2023 once the contracts are signed. Well, things like insurance, it is just trickling down so slowly that those increases are still felt by a lot of apartment operators at a time when income's not coming in on the other end. So it's a little bit of you've got this strange situation, I think, because usually inflation would increase expenses and rents at the same time, but now we're very much at opposite ends here with the income coming in as low and the expenses that are still growing or at least elevated. So not a whole lot of room to breathe, but it has rewarded, I think, those operators that can be efficient, that can still deliver the experience and kind of fulfill their responsibilities. And, and I think they're going to realize a lot of gains on the other side of it.
I think so. On the insurance piece, I think that's so lagging and it's kind of dragging itself through just because it's taken a while for these insurers to kind of like reset their pricing. And man, I'll tell you one thing, it is challenging out there, Matt, on the insurance end. If you're buying an older vintage property, they've made it much more difficult. Insurers don't even want to insure certain properties, and it's made us switch our strategy to we're really no longer looking at anything built before the mid 90s. If it doesn't have a sprinkler system in it, we're really not looking at it that much not anymore. Not that there aren't good opportunities in deals that were built in the 80s or even deals in the 70s. We stopped buying deals in the 70s a couple of years ago, and we kind of mid 80s was the oldest we would buy. But now, and we bought a mid 80s property earlier this year, and it was so challenging to get insurance. And we were having a hard time finding a carrier to even cover it. I mean, it's like even the same carrier that had the policy, there were no claims on the property, and they were like, they didn't want to cover it. And this is a huge policy, and like it didn't, it was hard. The market was hard. And so we made the decision we're probably most likely not going after anything that's like at pre-90s, mid-90s, just because it's almost uninsurable. And that doesn't bode too well for the housing stock and multifamily investors where that's kind of their bread and butter.
We're going to talk about this Harvard middle income affordability policies, and all of them are earmarked. Well, there's a couple of them that have rehab money, but all of them are for new construction. A lot of the focus on building housing supply is on building new buildings, and probably you're going to get your most bang for your buck there. But these buildings don't maintain themselves, and the pressure of maintaining a property could mean that not only that we don't have enough housing, but that people's quality of life goes down, and that's kind of horrible. And I wonder what programs or what's going to happen to these existing older buildings if insurance money makes it less lucrative or not at all profitable for people to operate them.
Well, I mean, yeah, it's a great question. I mean, the market answer is that the prices are just going to get so low because no one's going to want to buy them, and then the prices keep going down lower and lower and lower and lower until you can afford the expensive insurance. I mean, that's the market answer. Will you see? But again, that flies in the face of we're seeing prices stabilize. And is there going to be such a wide spread between kind of the more insurable properties and the uninsurable? Maybe. I hate to suggest government intervention, but the low income housing tax credit scheme, the LIHTC, is certainly kind of the tool that we have that is pretty effective. I don't think it's perfect, but I think it's a tool we have, and it's certainly better than rent control by all means.
Let's talk about that then.
Let's talk about it. Let's get into it, Matt, because I mean I'm in Barcelona right now. I'm in Spain, and it's the same conversation. It's the exact same thing. The housing crisis is not isolated in the United States. It's the same conversations.
They're squirting people with squirt guns there.
They are. They don't want. I guess they don't want all the tourists to be here. Some. But then they're like, you
scheduled your trip long before the squirt guns came. I'm sure of it. So it's not your fault.
A year ago. Yeah, it was, I didn't know about it until we were here. But it's not surprising. Crowded cities.
Not enough housing.
Where there's just not enough housing. And people really don't want to admit because they see real estate investors as the bad guy in this. And when in the reality, they're the only ones that can really solve the problem, unless you want the government to solve all the problems, which even left-leaning economists have acknowledged like that's not the most ideal solution or even a solution at all. Maybe there's some sort of, public-private partnership. But yeah, you can't really build up in Barcelona. It's one of the most dense cities in Europe. Yeah, there's not. I mean, it's very dense. The city planning is incredible. At least the stuff that they built kind of in the 19th century. If you've seen, they're all on these blocks. Really well designed. The excellent public transit, really well laid out. Everything's really wide, very lush, really green. But Airbnbs, there's a ton of Airbnbs and apartments. That's made the locals very upset because that's pushing, locals out, not enough housing. They don't like building new housing. They're just not that into it. And they're very restrictive on where and what. And it's this problem that's compounded over time. It's like we're in a little mini California. It feels it's not, but it's similar climate and same restrictive housing policies.
And that's what I was going to say. It's interesting about the go-to solution. Is it going to be to restrict people's ability to do something, or is it going to be provide resources to get them out of that problem that they're having? And if you can't build up, even my wife was actually talking about the squirt guns in Barcelona, and I was like, no, it's a thing that what they should do. Put them all in a hotel instead of spread them out Airbnbs. You can put them in we talked about this 3 years ago, remember? And it's an easy solution. You can stack all those tourists right on top of each other, and it's called a hotel. But I guess I can't build it.
True, and I think that's a good point. And again, you know me, I'm not big on really kind of the government telling anybody what to do, but maybe you're not allowed to have Airbnbs, and if it's zoned residential, you can't be operating a business. I mean, that's just like kind of basic zoning, and I'm not someone who's like absolutely opposed to zoning everywhere. But it's just it's economics and it's math. It's like there's so much supply, and if you take the stock of housing, where someone would live and replace that with hospitality, well, it's kind of zero sum if you're not building more residential housing. And so Airbnb is fine if you are supplementing the existing housing stock with new housing of any sort, rental housing,
very good
for sale housing. Most likely, in here, they don't like necessarily to build. Obviously, Europe's much more of a renter's nation. If they build anything, the concern there is wealthy folks from the UK or Dubai or wherever just buy it and park their money, and so locals don't even get to buy it. And that
happens in New York. That happens in Vancouver.
Happens everywhere.
Yeah.
These high cost of living markets that that just the perception that they're just going to keep appreciating, and hey, New York's not going anywhere, and that's maybe it probably is not. But the solution, and again, I just for fun, I've been talking to tour guides. I'm on the Barcelona, subreddits and forums, just trying to learn what's going on. And again, it's funny. It's the same conversation. And again, but people are suggesting new supply, but it's like there's so much resistance to the one solution. Again, I think it's because it involves real estate developers, and real estate developers are viewed as the bad guy instead of the one group that can actually solve the problem, but it's just the government and unfortunately the population that's getting in the way.
I'm sure it's a growing population. And even if you kick out the tourists, that's not going to address the population growth.
Well, if they kick out of the tourists, the industry here is like there's other things going on, but again, it doesn't have to be zero sum. Let's think a little bit bigger here. And again, I'm not going to solve all of Barcelona's problems here in the next couple of days, Matt. But I do wish that and this might coming back to the conversation, whether it was Chris Salviati or Carl Whitaker that we've been having, that we've gotten some great data in the United States, probably elsewhere, but I'm most familiar with the United States, showing the effect of new supply on rents. Again, we're seeing it right now in the South. We're seeing it right now, that negative rent growth in this, despite that there's so much incredible demand in the South, but they built so much. So instead of screwing with markets that politicians don't understand. Just build more. That's
Yep.
the solution.
Yep.
Occam, there's straight path. Occam's razor. You know how to build it. Just build it. Keep doing it. You don't need to create new programs and don't make it any more complicated.
Yep. Yep. Agreed. Or could put rent control in. It's
Oh my
so
God.
easy. You can just snap your fingers.
And it fixes it. And it fixes it.
Yeah,
Right.
yeah,
It solves all the problems, and that's why we keep doing it. Right.
Yeah. Well,
all right. So Globe Street's got a new report on rent control,
yeah.
Matt. And again, this subheadline is, while well-meaning, these policies are riddled with unintended consequences. The nail on the head, but give us the rundown.
Yeah,
thinking about rent control, because I was talking to Chris Salviati. He did say he did. I don't know if you've listened to it, Matt, but he was not completely opposed to rent control. He was saying in the right circumstances, the right locations, it has a role to play. Now he's from San Francisco, and I'm not going to hold that him being California against him at all. Really nice guy, really smart individual. Well intended.
And it's almost safe to say to talk about rent control now, because the consensus is so huge against rent control and towards kind of supply increasing policies, but it's still so such a digestible idea that it will always persist, and we'll always need to keep the argument against rent control in kind of the back of our pocket, because
it's same with like tax the rich, right?
Yeah, exactly. It's this idea,
but even worse.
Yeah. Actually, I did think about this. The one benefit I feel like rent control could bring, and it's only a theoretical benefit, which is kind of like why it is successful. So rent control thrives on this idea that's like, if you can just snap your fingers, rent goes up anymore. It's hard. It's way easier to enact a rent control policy theoretically than to build an entire apartment building. So I mean, that does not take into account like legislative barriers and how long it would take for any rent control policy to be formulated, to get approved, et cetera, et cetera. But theoretically, the lawmakers could just say, hey, rents aren't going up anymore. Guess what? And that sounds great. It sounds super easy. But obviously, Bob Pinniger, the author of this Globe Street article and the president of the National Apartment Association, is a little bit skeptical of that idea. And this article is really written in the frame of a lot of the expense pressures that we were talking about just like 10 minutes ago, whether it's insurance or a slew of other expense pressures that will come creeping up and really kind of to the detriment of the lives and lifestyle of renters in apartments that are in rent control areas. He says that rental housing providers continue to experience incredibly narrow margins that cannot sustainably withstand additional strain. And he talks about how, according to the National Apartment Association's research, 93 cents of every rent dollar pays for things necessary for the operation of rental homes. A couple of weeks ago, I did make reference to the multifamily business as like a marginal income business. I remember hearing that it was in an Urban Institute article a couple of years ago, and it's not a passive income; it's a marginal income business. It's something that you have to work for. 7 cents on the.
Don't tell anybody about cash out. Don't tell anybody about cash out refis.
All right. Yeah, I'm not going to interrogate that much. Neither am I going to interrogate the 7 cents on the dollar.
He's true. It's a low margin business. It's not like it works well as a levered business or a long-term, capital gains business. It's not like most other, that's what some people don't understand. It is people like real estate, people like multifamily, because it's consistent. You can get decent cash flow relative to the amount of risk you're taking. If you bought another business, because that's what we're doing when we buy apartments, we're buying businesses. Yeah. They're not just brick and mortar. It's a business, cash flowing with employees. I buy
pest control,
a franchise, pest control, cleaning, what you name it. The cash flow is like double, triple. You can get better cash flow in a business, but those businesses are volatile. They're specific. They're very market specific. They're hard to replicate. They're hard to scale, et cetera, et cetera, et cetera. So the margins on real estate are relatively low, but you can get decent cash flow. You're going to get more than sitting at a bank. You're getting much better overall returns in the stock market. There's some tax benefits, but it's leverage that allows one to create incredible amount of wealth in real estate But yeah, if you think of it as like your mom and pop business on the on the corner, now again they may have a lot of equity built in that business, but yeah, the margins aren't huge.
Yeah,
True.
I was thinking like, okay, every time Apple sells an iPhone, I'm sure they're probably making a little more than 7 cents on the dollar. But I also think that apartment operators just flatly aren't exactly making money hand over fist. And and like we mentioned earlier, they're dealing with lower rent growth now and higher expense growth. They've been dealing with it for about a year and a half. We had a cushion in 2021, with the huge rent spikes, but that is just a faint memory. And I think that a lot of apartment buildings have been bought since then, and their valuations have made it so that no, we bought it under the assumption that expenses weren't going to increase that much. So the strain is still there. I'm, maybe it's a sense
I
of
remember for a
greed,
while, Matt.
but yeah,
Yeah, I remember for a while. This was in 21 or 22 or so, and kind of early on as inflation was picking up. We knew inflation was picking up, but it was kind of a new phenomenon. Everyone was kind of getting used to it. We're
yeah,
like, rents are growing. What? And then there's other expenses.
hmm
You're looking at models, and I remember being like, "Hey, you can't assume. We can't assume.
yep,
No one should assume 2% inflation. Because
yeah,
everybody,
yeah,
in a multifamily model usually has, a variable for inflation,
hmm,
for expense inflation, because you're growing your rents at whatever, obviously whether you're doing organically or doing some, value add and rehab and charging a premium. If you've got your rent growth, which again, standard, organic, historical, around 3%. So you're growing rents at 3% and expenses are growing at 2%. And obviously there's so much more to apartment investing, but that is kind of the key right there. Your income is growing in any
yeah,
business. Obviously, your income is growing faster than your expenses. That all of a sudden, expenses it's like three. No, maybe three is
yeah,
reasonable for over a 10-year average now. But right now, inflation is 5, 6, 7, 8, 9. It's
yeah,
not two. And there, is it was a variable that never changed in the past. And in
hmm
fact, for many years, inflation was less than 2%. There were probably people that were using 1%. Some people probably weren't even trending any sort of inflation, which is
yeah,
very
yeah,
irresponsible to do. But we had to catch up and use 3% plus,
yeah. So
and figure out what that average is over 10 years.
in the context of rent control then, so we've got this picture of the kind of pressures that operators are in right now, and I know that there are probably still mainstream articles talking about how rent growth is so high, and we know that it's not quite so
Yeah,
high,
yeah, yeah. Citing
especially
citing CPI.
yeah, especially if you have rent control. Bob Pinniger cites a report that the NAA recently put out, and I'm just going to summarize the first conclusion before reading more detailed descriptions of the report. Basically, rent control leads to broken down apartment buildings. That this was an interesting thing because I always see rent control framed as, well, it discourages new development. Now he does note that here, and I'll talk about it in a second here, but he also says that. Here's the quote here. When the number of rent controlled units in a metropolitan area doubles, there is a correlation of a 16.2% increase in severely inadequate housing units and 14.7% increase in moderately inadequate housing. Now, they define this as critical issues like major plumbing or electrical problems, health hazards, structural damages. These specific things are like heating equipment malfunctions, mold problems, the presence of cockroaches, rat and mice problems, much more than like a leaky faucet. And it's not like, well, maybe I'll ask this. Do you think, could it be that apartment owners and operators, once rent control is put in place, that they purposely don't take care of their buildings out of spite for this policy? Because I don't think that's true. I think that you're just decreasing the resources that landlords have to fix the pipes or to spray for bugs or whatever it is. They just don't have the resources to do that anymore. And I can't. equate all of this to greed. The kind of statistical analysis they have here, it's not just one mean landlord that's spiteful and choosing to live in the lap of luxury while all of it, that's like this slumlord stereotype. I don't think that it's all this kind of slumlord effect. What you're doing essentially is reducing the resources that people have to deal with the problems. And where are they going to find the money? Well, sure, I'm sure maybe they'll take a hit on their own profits, but at some point it's going to mean that the money they have to take care of the buildings themselves is not going to be there, and it's going to lower the quality of people renting.
You make a good point. I mean, if you have a long-term perspective, you want to maintain your property because you want to do deferred maintenance because it reduces expenses over the long term. It might even prevent you having to have some major CapEx expense. So I think you're right, Matt, for I'd say probably 80% of investors. Now, I think there's 20% out there that are kind of scumbag slumlord landlords. Like those folks do exist, unfortunately, and screw those guys because they make all real estate investors look bad. I don't know if it's 20%, maybe it's 5. It's either 5 or 20, man. And there are guys that are probably doing fine. They probably could afford to fix something and they're not because of some greed. I think that does exist. But again, I think it's the absolute minority because it's not good business sense. But to your main point, it's just the reality. If the money isn't there, you can't fix it. If you can't, and if there is no return, think of it all through, again, in investment. If there's no ROI on the improvement, I'm going to fix up this apartment. You'd like to see some sort of return on that investment. And usually you're going to get that from some sort of increase on what you're charging. And it's just kind of basic business. You prove something. It's a higher quality product. You should be able to charge a higher price for that higher quality product. Now, maybe you're saying it's not really high quality. It was just unusable and it was below standard. And now you're bringing it up to living condition and now you're going to charge more. Well, the fact is the cost to provide that livable apartment is the cost of the rent. So if you want to have clean, safe conditions, there has to be some sort of economic incentive to be able to provide those. And because it's not a charity, landlords are in many cases losing money on a cash on a monthly basis because their interest rates are through the roof. They've got inflation that has hit from payroll and insurance, everything we've talked about. And now if they're being told they can't increase their rent, well, there's no way out.
That's interesting.
They're just gonna hold on to the money because they're paralyzed.
And so Bob Pinniger frames it as a failure to take a housing provider's financial constraints into account. But I also like your framing of it as it also, sure, it restricts, but it also provides no incentive to take a positive action. Why are you going to even think about doing it? Fixing the crumbling balcony or whatever it is. Why you're not going to do it because you don't see any gold at the end of that rainbow. There's nothing to incentivize you to do it. And it's not greed. It's just like, listen, these guys are sitting in front of Excel spreadsheets and they've got to deliver for their investors, et cetera. And sometimes, like Bob Pinniger says, you just don't have any money to do it, period, let alone anything to incentivize you.
Yeah. I mean, that's the thing. It's like, if you just don't have money, like you can't assume that the owner has their own they can even just dip into their own personal bank account and write the property a check and make a donation to the property. Maybe they can. I think that's a pretty large assumption. I mean, obviously, if it's a syndication, you have partners, then it gets even more complicated. Sometimes it doesn't necessarily have to be, but it's you're really not incentivizing the right way. Again, housing is not a right. Especially when we're talking about market rate housing, when I can go choose, I can take my dollars and live different places. You're obviously limited on your budget, and affordability is an issue. And some people don't have that many choices, and the cost of housing is so high, as we've talked about. It's not easy, but the fact is, just the system that we are operating under, is not one in which housing is provided as a free service, and landlords are just providing that service and they're being compensated by the government. It's not like everything's Section 8.
And that would be the only way that rent control would work, is in a system where the government kind of has control. But rent control is taking things from a government controlled system and putting them into a market system, and that's not going to work.
Yeah. I mean, it would be like if the government told Chipotle they could not charge any more than $9 for a burrito.
Yeah.
And you know what? The quality of Chipotle would go down.
Yeah.
And that would be a damn shame to everybody. And no one likes paying more for a burrito that's getting smaller.
Mm-hmm.
But again, if they limit, we can't charge, a little bit more for El Pastor chicken. If they're capped. And again, it's like, well, what are you talking about? You're capping a burrito. Well, the same conversation, the same breath, you talk about, housing is a right. I don't see why food isn't a right, because you need food to survive.
Yeah.
You need water. There's all sorts of things that we need to survive. But, I don't know who is magically bestowing these things upon us unless we just want to accept some overlord over our lives, which some people are very happy to do, man. But as Americans, we're not there yet.
Yeah. I do think, it is easy to get fired up about the drawbacks of rent control. But I do take a little bit of solace in the fact that for the most part, the consensus, like I mentioned before, is that rent control is an ineffective way to make housing more affordable. It does seem like policymakers, for the most part, realize these unintended consequences of this kind of restrictive way to make houses affordable.
But Joe Biden did throw it out at the debate.
And that's why,
last week. But
I think
he threw it out. He's like, we're going to cap. He's like, and we're going to cap the rents.
Yeah,
like it kind of blabbered out. I think he just said it. That thing about policy, it was just like, this will get a win for the crowd. But he said it. It was on his mind.
And he probably said it because he heard it. It's still in the conversation. It's still pervasive.
It's in the lexicon for sure.
From time to time, it will become necessary to remind people of rent control's flaws. But fortunately, there are other solutions out there. Yeah.
Well, that's what we're trying to do. The good work here on Gray Report, Matt, every single week, and debunking rent control in all of its forms. All right, Matt, let's move on to the Joint Center for Housing Studies.
It's interesting reading this report from the Harvard Joint Center for Housing Studies up against the rent control article, or the rent control study from the National Apartment Association. These are both written by academics. One is from the NAA, was a professor at the University of Illinois, I believe. Now I'm probably gotten that wrong, but these are professors. These are academics that are writing on these topics, and it's very clear that the Joint Center for Housing Studies is laser focused on housing affordability, on the perspective of renters, on alleviating their programs. And it is also kind of worth noting, maybe underlining here, I didn't really notice an emphasis on rent control or any kind of restrictive housing policy. All of these are meant to kind of encourage basically building new homes. Now, the article summarizes that recent working paper. I'll provide the link in the show notes here, but they are looking at housing programs geared towards increasing affordability for middle income as well as low income. And they point to 4 benefits, which is incentivizing housing development. That's the primary one, and I think is the most salient one for our discussion here. The second one is encouraging mixed income housing developments by increasing the range of price points available, so kind of mixing different groups together. And third is preventing low-income housing for households from encountering a benefits cliff when they earn more and no longer meet the eligibility criteria. So it's kind of acting as this bridge between low-income housing rental assistance and market rate housing. And then finally, this is my favorite, middle-income housing policies and programs address and alleviate the affordability challenges of middle-income households directly. I like that because it's that's what we're doing here, saving people money. So it leaves them more money to spend however they want it. We could talk about airy things like increasing housing supply, but I'd like a little more dollars in my wallet if if I can. Of the 11 example middle-income housing programs that they cite here, and we've got them listed here, it's not all in one area or region. I was wondering whether it's like blue states or red states, but they've got Kansas and Florida and Georgia alongside Michigan, Colorado, Rhode Island, California, Minnesota, Pennsylvania, Massachusetts. Colorado's twice there because they've got one that's like a Breckenridge specific one. I'd love to know what the middle income looks like in Breckenridge, Colorado, but all of them
Pretty high.
That's what my guess is. All of them are, well, for the vast majority, what you get here is loans, bonds, grants, and loans. There's a program that Breckenridge one does provide utility hookups, fee waivers, and land donations. And then the one in Florida gives you tax exemptions. But for the most part, you're looking for funding, money earmarked for new construction. There's a rehab, some adaptive reuse things here and there, maybe a conversion, but it's clearly a strong preference for new construction, as they quote on the entry for Massachusetts. So I think this is a very encouraging set of policy ideas that are very much focusing on increasing housing supply. Let's see if those
Matt, they're going to have to do something because, at some point, the way this is going, I mean, where California is headed, so many of these older apartment buildings, are just not going to be like up to standard of like in terms of energy efficiency, and just not up to par for the way that, housing standards are going forward. And now, can they be retrofitted? I mean, again, the conversation is on new development because that's kind of sort of in a sense, it can be the cleanest, but it can just be like, here's our package and plan, and then we'll all get all figured out and we start building it rather than here's this existing structure that we have. There's people that are living there, and how do we reclassify it, and do we have to move people in and move people out? But again, as we talked about, there's a huge amount of housing stock that was built in the 80s, in the 70s and 80s. And it's hard to insure. They need significant dollars invested. This is our housing stock that we have to support, and which is why, I've been saying for years now, you're investing in multifamily for plenty of reasons, whether that's diversification, whether that's cash flow, capital gains, tax, a lot of reasons. But the patriotic thing is, and the egalitarian aspect of it is, you're investing in housing stock, and we do have a housing crisis. We've talked about it all the time. Crisis all over the world, and we have to support that housing stock. Because if we don't invest those dollars, those units go offline, and we reduce supply, and that increases prices even further, and that puts more pressure on middle and lower income Americans and people all over the world. And so we have to either support and maintain this housing stock, or we have to replace it. And it could be either or. Maybe the decision is we need to replace it all, which seems super inefficient and not very green or sustainable when we have all these properties, and they just need, again, we don't have to get into all the government programs and how we're spending money and where we're not spending money, but if we are going to spend money on a program and they're not being done as efficiently as they could, and it is welfare for the rich in many cases, and the unintended consequence often is, or maybe that's the unintended consequence, but you end up getting more housing, you get good housing, you're lining the developer's pocket the whole way. I don't have a problem with that at all. I mean, like whatsoever, because they're providing a service that's needed. There's market demand. I'm just saying, let's just the reality of the situation. Those development fees are huge. But the government can't do it themselves because they've proven themselves absolutely ineffective and inefficient, and they're going to waste more money and line somebody else's pockets. But we have to have a solution, and I'm glad this conversation is taking place of, because many of these projects are restricted by regulation, by restrictive zoning. And the easiest thing would be to free that up. There is land. Cities just give land to developers.
You can give them all the money they want in the world, but if there's no space that's zoned for the kind of housing that you want, then sorry, you're going to have to drive 80 miles or 80 minutes every day to work because, there's just nothing zoned in your area. That's but what you were saying about these buildings that were built in the 80s or really even the 70s when they had this big building boom, it almost seems like we could be approaching the point in the lifestyle and the life cycle of these buildings where things just start sharply going down. Building could be good, 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 and then at certain point there's a breaking point where maybe everything starts going wrong, and you blink,
and that's my fear.
Yeah.
I think that you're exactly right, Matt, and that's my fear right now. Again, talking about insurance, talking about how, like what I've said, I can't buy 70s and 80s buildings anymore. I can't. I'm not the only one that's saying that. You're going to hear a lot more of that over the next year or so. Who's going to be buying these? Either the prices have to go down, and it's going to take a lot of distress, and people are not going to be throwing money into them as the prices are dropping. I'll tell you that much. And so it is a problem. I think we're right on the heels of it. And I think that, again, the conversation shouldn't be about rent control. That doesn't solve any problem at all. It makes the problem worse. Talking about getting rid of regulations, getting rid of rent control, getting rid of any barrier for folks to get in. And I think the I don't understand some of the nuances of the insurance industry. And so I'm not gonna tell anybody to be investigated. It just doesn't make sense to me. It does make sense, you said, but it is insane.
So like one of the things you look for is like, it's got to have a sprinkler system. Sorry, that's just a line item I look for. It's like the brown M&Ms for the ACDC or whatever. Is like, that's your
it's always something new, whether it's lenders or insurers. They've always got like the new hot button thing every year. Like one year at HUD, it seemed like it was power lines, and they were like, we got to do a fall study. I'm like, we have to do all these fall studies for all the power lines. And I'm like, we bought this building last year, and how these, you didn't say anything. And they're like, well, this year it's fall study year. We're going to really look at power lines, and we need you to conduct a full fall study if these things fall down. Wow. And then I like, so it's whatever, it's the process. You got to do it. Yeah. But Matt, this was a really great episode. I think we covered, what's going on in the market, some of the challenges, and then some of the areas that I think are uncomfortable and are kind of outside of just what's on the front of investors' mind. But really, I think it's just really full spectrum conversation on the state of the housing market, especially multifamily. So great episode you put together.
Thank you so much.
Where can people go to get this information every week and more?
You can go
to any place I can go.
Well, you can go to the Gray Capital LLC blog if you want, and we've got our each week we have the newsletters is posted there, or you can sign up for the newsletter at graycapitalllc.com/newsletter, or if you want to go to the Gray Report website, we've got every day updated with new articles and research reports tracking the latest from the multifamily industry, housing, and the economy. So a lot of stuff you can follow, or subscribe or follow this podcast and YouTube series if you aren't already a subscriber.
A lot of things to do. You got your homework.
Yeah.
At least subscribe to Gray Capital YouTube channel. That's right, Matt. And then Gray Capital LLC.
One thing at a time. That's all.
Get on the newsletter. No, but do all those things. Do everything that Matt just said. We appreciate you taking the time to watch this episode. We've got a great episode from Chris Salviati that I did last week, getting into some latest research from Apartment List. We cover the Apartment List all the time. Got into a lot of detail with him. Fascinating conversation. Get in touch with us. Leave some comments. And check us out. Talk to you next week.